Okay, let's spend some time on investing. Now, I spoke so much about savings because you need to first of all start by saving before you invest. And the idea about investment is that any money that you will need within the next 5 years should not be invested. As you can see in the chart on the screen, you can see that if this is an investment portfolio, it goes up and down with time. And if it goes up and down with time, if you put money in the market or you are investing your money for a short time, then as it goes down, if you need the money, you can get less than you put into the investment. So if you want to invest, then we recommend that you have emergency fund first, at least £1,000 saved in savings before you can consider investing. And investing, many of us might have seen YouTube videos or videos on Instagram where someone is flashing a very nice car and they tell you, they invested to get that money. It may be true, may be false. I don't want to judge, but if it is true, it is an outlier event. Investing generally is not as exciting as people makes it out. Investing can be very boring, but then it is a long-term thing. So your investment really doesn't need to get you excited when you are just starting. You just need to make sure that you are doing something very important. Investing is not about buying and selling stock whenever you want to. No, that is not investing. That is trading. Okay, so there is a difference between investing and trading. So when you are investing for the long run, 10 years, 15 years, 20 years down the line. So it is most times a slow and steady approach. So if you know that you have some money that you will need within the next 5 years, I strongly recommend that you put it in a savings account with high interest rate rather than investing it. So while that has been said, let's talk about what investment is or what investing is. So investing is the process of mainly buying assets like shares in a company with the expectation that you might be able to profit over time from it. So if you are an investor, what it simply means is you find a company, you like the company, you own shares in the company, even if it's a tiny bit, it means that you are already investing in that company with the hope that with time, your investment that maybe you purchase for £1 today can become worth maybe £5 in the next few years. So that is the whole idea of investing. However, for most people, investing requires a slow and steady approach. So it doesn't have to be that, you put in £1,000 today, by the time you wake up tomorrow, it's already £1,500, 50% into in 24 hours. Some people might be able to trade to make that kind of money, but because they can make 50% today, also means that they can lose 75% or even 80% tomorrow. So trading is different from investing, and this is something that we need to pay attention to. If you are investing, it is most times slow and steady over a long period of time. If someone comes to you and say, I want you to invest £1,000 with me and I will make it £2,000 in 2 weeks, I will consider that as gambling and not investing, because from my understanding, investment can go up and down, but for someone guaranteeing you that they will double your money in 2 weeks, it's not something that is really, really practical, except that person is a very experienced trader. And even at that, you need to be mindful of how much fee they're going to charge you. So like we always say, if it looks too good to be true, most times it is not true. Okay, so when you talk about investing, what are some of the things that you can invest in? Now, the reason why most people invest is because investment often do better than cash savings over time. So imagine if you invest £1 in 1900, that's several centuries ago. Today, that £1 will be worth £386. That same £1 in today's currency, if you had invested it in another asset called bonds, will be worth £4. If you had invested that money, or if you have saved it as cash, it will only be worth maybe £2. And why is this? Because any money kept in cash is often eroded by inflation. So we recommend that you save some money, but not every of your money should be left in cash. Only a part of it should be placed in cash, then the others invested. So what can you invest your money in? Number one, you can invest your money in what we call equities. Equities or stock simply means you are buying shares of a company. So for example, you shop in Tesco, you know that Tesco is a very good company because a lot of people will buy things from Tesco on a daily basis. Then you think, oh, Tesco is here to stay because they have very huge presence in the UK. Then you buy a part of Tesco, and you buying a part of Tesco means that maybe in the future when Tesco make profit, maybe at the end of the year, they declare £1 billion of profit. As a shareholder, you get a portion of that profit in the form of dividend. So when you invest in a company, the company makes profit. At the end of the year, they distribute part of this to the investors like yourself. Even if you hold 0.01% of the shares, then that distribution of profit to you is called dividend. And that dividend is part of the reason why people invest in different companies. And you also invest because you think your £1 investment today in the next 10 years, 20 years should be worth more than £1, even taking into account inflation eroding the value of the money. Then, apart from equities or shares in a company, you can also invest in what we call bonds. Bonds are also called fixed interest securities. And so this is where you lend money to a company, we call it them corporate bond, or you lend money to government or government bonds with the promise that the government will pay you regular amount of money on a regular basis, or maybe sometimes on a monthly, sometimes on a quarterly basis, or even on a yearly basis, because you can have bonds up to 10 years and some are short-term bonds up to 2 years. Then the government or the company raise money from you, they will be paying you back some interest or fixed interest on that money over a period of time. And the good thing about bonds for most people is that the amount that you put in will also be given back to you when the bond matures, maybe after 5 years, after 10 years, or even after 2 years. So bond is like a fixed interest security. So you get a fixed interest on your investing, and at the same time, you still get your capital back at the end. So it's usually a safe haven for a lot of people when they are approaching retirement age. Then you can also invest in real estate, that is buying properties, maybe doing the property up and waiting for the property with time to appreciate in value that you can sell. Then you can pay capital gain tax on it if it's a investment property. If it's your personal property, then you don't pay capital gains tax. So you can buy a property for £150,000, and in 10 years you sell it for £200,000. £50,000 is now the money you get on top of your original your purchase price. Of course, you also need to think about inflation. How much is that £50,000 now worth after 10 years? But again, real estate is another very good investment for building wealth. Then there are others, and others here can mean commodity. For example, you are investing in gold, you are investing in silver, in coffee, and so many other commodities are out there. You can also invest in art. Some people buy art and artwork, and you see that, oh, this artwork is worth £1 million, £2 million. Some people invest in that with the hope that in the nearest future they can sell it for more. Some people invest in wine. Some people invest in classic cars. So they buy cars, classic cars, and they keep the car for some time, and then they sell it down the line. If you For example, someone can decide to buy a new Toyota Camry in 2023 and only drive it for 5 miles and keep that Toyota Camry in good condition for the next 40 years. If he bought it for £20,000 this year, in 40 years, because it is new, no mileage, very low mileage, they can sell it for more in the future. That's what some people do as their own investment. But of course, you know that they are already rich for them to begin to explore that. And then some people go into cryptocurrency, some people invest in Rolex watches, and so on. So those are different flavors of investing. However, I think for many people that are just starting out, equities, bonds are the easiest way to start the journey. Okay, and that's why in the next few minutes I'll be focusing mainly on those aspects. Okay, so when it comes to investing, you can invest in equities like we mentioned, in bonds, but one thing that you need to pay attention to is that you must diversify your investment. And what does this mean? It means that you should not place all your money in one investment. So, this is the saying that you should not place all your eggs in one basket. And what does that mean? Don't place all your income, all your investment in a single share. So, for example, many people will say, oh, Tesla is going to the moon, and they put all their investment in Tesla. It could be true that the shares is doing very well today, but if Tesla as a company, for example, decide to fold up or go private, then you are the mercy of whoever is buying the company to determine how much you will get, or you are the mercy of the market not crushing Tesla as a stock because they did not deliver the number of cars that they promised to deliver. So buying just a single share is a very risky, or a single company is a very risky approach. So the best approach is to diversify, buy multiple companies, buy different, maybe a mix of equities and bonds, and that's what we call your asset allocation. So if you're starting out, you can decide to mix these things up. So if you buy equities or shares in companies, if you buy bonds by government or by company, that is your asset allocation. So how you mix it up now determine the percentages. So you can decide to invest 50% of your money in equities, 50% in bonds. That is a 50-50 asset allocation when it comes to investing. But the idea here is diversify your investment such that if anything happens to a single company, it doesn't impact you on a large scale. Okay, so how you invest now also depends on your risk appetite. So some people are very high risk tolerance, some people are very low risk tolerance. That's talking about risk management. Some people, it's about you managing your risk. You check yourself. Do you feel very anxious if things are not going your way? Then that tells you about your risk level. So you need to be able to manage it such that you don't wake up one morning because things are not going right, you sell at a loss. Investment is for a long term and not a short term approach. So if you can see the slide on the screen, this is an asset allocation on the screen. And on the bottom, you can see what we call volatility. And so we have a higher risk going from left to right. And on the vertical axis here, you have compound return, that is from 0 to about 12. That is number of annual returns on your investment. So I've talked about the different investment options that you can explore, maybe bond, maybe maybe equities, or even cash. But if you look at the bottom and left corner here, you can see cash. Cash is less volatile, the risk level is low, but at the same time, the return on your investment is low. Okay, so you can see cash here is low in terms of return on investment. The risk level is also low. Then if you move on the bottom axis here, move towards the right hand side, you can see that volatility increases, high risk assets begins to also go up in terms of the return. So if you consider the next item that we encounter from moving from left to right is the bonds, the global investment grade bonds. And you can see compared to cash, it is more volatile, that is higher risk, but the return also increases. So you can see UK gilt is simply UK government bonds. It has a very high risk, but then the return is also around 3%. Then if you go towards the left hand side as we approach, a very higher risk is to invest in global equities. But if you invest in global equities, then you have a higher return, about 10% annual return. And then this is comparing to cash. You can say higher risk means higher return in most cases, but then lower risk means lower return. Now, if you put this in perspective, this what you see on the y-axis here is the annualized return. So it means that sometimes your global equity can return negative, it can go down in value, but it can also go up in value. So, but if you look at it on an annual basis from 2004 to 2022, if you invest in global equities, you can get up to around 9% or more on an annual basis. And this is why people will say that your global equity will return at least around 9% annually. But doesn't mean that every year you get 9%. Some years you can get 7%, some years you can get 20%, some years you can get minus 1%. But the idea is if you look at it in the long term, you will still go up in value. So this concept here is that if you invest in money that you will need in 2 years, it means that within 2 years it can go down in value. If you take it out in 2 years, then you lose money. But if you leave it there in a long term, over 10 years, over 20 years, you can be rest assured that it will go up in value. And that is what people do in order to build wealth for the future. Okay, now time is very important because again, there's so much to cover and we still have some questions to answer. So there is a difference between passive and active investing. Now, passive and active investing generally refer to your flavor of investing. For some people, they prefer to invest in what we call the global index fund. The global index fund simply means you buy the entire stock market, not minding an individual stock. So you buy everything at the same time. So rather than looking into Tesla or into Tesco, into Sainsbury's to buy their specific shares, you don't just mind, you buy everything on the stock market. And by buying everything on the stock market, it means that you are a passive investor. So this one is more of a set and forget. So on a monthly basis, you can say, okay, £50, £100, go into this buy more of these funds. And as time goes on, you begin to see the value of the portfolio grows, the return also grows. Now, the other aspect of flavor is where people invest in active funds, so active investment strategy. And here it means that you buy specific shares of specific company. So this one is a little bit more risky in the sense that you have to take time to do your research about the company before you invest in the company. Some people buy shares in a company, very expensive shares, and all of a sudden the company goes bankrupt. And if a company goes bankrupt, you have lost all your investment. So imagine you put your life savings in a single company and the company goes bankrupt at the end of the day, then you lose your investment. So sad. So and this also requires a lot of effort. So you have to read prospectus, you have to understand what the earnings to share ratios of the company is. You need to understand and say, okay, from the results in the annual statement, is this company going places or they are going to flat out or even decline in the next 5 years or the next 2 years? So those are the things you need to do if you're an active investing. Of course, these days you can easily use apps like Trading 212 to just buy shares of company. But if you do that without doing research, you can be losing money over time. Then investing actively also involves some companies having fund managers. So investing in actively managed funds mean that you can then, they charge you funds, they charge you for, managing the funds, sometimes up to 1%, and 1% of your, or 1% charges can take off maybe 28% of your return over 15 years. So you might think of it as just 1%, but that 1% can wipe off about 28% of your investment returns in the next 15 years. So it's not just 1%, it's also cumulative or compounding. Then if you sometimes some people say, oh, I'm looking at Tesla, I want it to come down before I buy. That is timing the market. But really, time in the market is better than timing the market. So you cannot time the market. Instead, just invest on a regular basis, and that will come out much better than trying to time the market. Okay, now aside from active investment or even passive investing, there is a new flavor of investment called the robo investors. So if you have some apps like Moneybox, those apps, they will put together some passive funds like Vanguard funds, and then they will actively manage it, and they charge you more. So robo investment or investors on apps like maybe Plum, maybe Moneybox, they are good for a start, but then you are paying so much in charges, and that charges can wipe away a lot of the value of your investment. So as an individual, I prefer the passive investment strategy, which is a set and forget. Just every month, set up a direct debit, pay a certain amount into this account, buy this particular fund, and forget about it. You don't need to even check on a monthly basis. You don't even need to check regularly. You can check once a year when you are checking your finances, check twice a year, but you don't need to log in on it every day. Just set and forget for a year or so. And with that, you are not under pressure to know what is happening in the stock market. Okay, now in terms of investment accounts, there are different ways that you can invest your money. Especially in the UK, you can invest in your pension, for example. So if you already have a workplace, that if you are working, then most likely you will have a workplace pension already. Now, this can be through NHS, it can be through Nest or Now Pensions. And if you are in the UK, there are some employer 401k plan that you might have been enrolled on automatically. So UK have automatic plan, okay, for this. So you can have a pension automatically invested, and with this you can then begin to buy shares or buy funds within your pension. Then you can also use stock and shares ISA as an option. The stock and shares ISA as an option is also available for you to invest up to £20,000 on a yearly basis within the stock and shares ISA. And another option that we will consider is the lifetime ISA. The lifetime ISA also, it has a cash option, and it has a the shares or investing option. And here you can also invest in different funds within the lifetime ISA. They also have their limitation. For example, if you want to buy a house and you are younger than 40 years old, then you can put some up to £4,000 in the lifetime ISA, and the government will give you £1,000 extra, and that money can then be used towards buying your house, or you can save it towards retirement at age 60. Then we have a general investment account. So for example, the first three options on the screen are for the pension, you defer the tax because you pay in before you are taxed. But for the second two, you pay in your after-tax money. So whatever money you put in there will not be taxed when you take it out. But the general investment account, you pay in your after-tax money. But if you sell and you make certain amount of money outside your threshold or your limit set by the government, then you will be taxed on that investment or transaction. So how can you then invest to build generational wealth. Number one, you can maximize your pension contribution and start early. So pension contribution is usually tax-free. So if you put in maybe £80, then because it is tax-free, the amount that actually goes into your pension is around £100, assuming you are a basic rate taxpayer. So because of this, you have extra 20% to grow, or £20 to grow over the next 30 or 35 years. So by investing in your pension and maxing out your pension, you can have more time for your money to grow in the market or in your investment. So and by starting early, it means that you have enough time for your investment to compound. Now I'm going to show you a slide on the screen, and then we'll discuss it very quickly. So imagine that for someone that starts at age 25 and they invest £5,000 on an annual basis. Starting at age 25 and investing £5,000 on an annual basis. Now, assuming that the investment returns 5% on an annual basis, by the time they get to age 65, the person that started at 25 will have about £639,000 in their account, in their investment account. That is, they are investing 5,000 yearly and assuming a 5% growth. But for someone that started now at age 35, by the time they are 65, they will have about 354,000 in their account. Now, the difference is just 10 years between their starting time, but and they are investing the same amount. Look at the difference in how much they will have by the time they are 65. So if you are already above 25, or you are between 25 and 35, and you want to start investing, that gives you an idea of how much you need to start investing now. Because if you are starting later in life, then the amount you put in should be higher than someone that started early. And that's why you cannot compare yourself with another person. Somebody else can start their investment journey at age 5, maybe age 18, for example. Some people start at 5 because their parents put some money aside for them. But some people start at age 18, and you are starting at 35, and they say they are only putting 2% into their pension, and you think 2% is good enough. Their starting point is different from your starting point. So you will need to do a lot more work in order for you to have decent retirement in the future. And another best thing you can do with your investment is, when you are investing, make sure that any dividend that you get from your investment is reinvested. So you are getting dividend or profit, for example, then make sure it's reinvested. If it is reinvested, for example, for someone paying £5,000 in 1986 and comparing that to 2022, by reinvesting their dividend, that is the profit share that you get from investing in companies, their portfolio will be worth £122,000 today in 2022. But if somebody decides to always take out their dividend, their profit without reinvesting, they will only have about £31,000. So you can see the huge impact of reinvesting your dividend. And that is truly the power of compounding. Compound interest will make your investment to go much faster than if you choose not to invest your profit or your dividend. Okay. I can't really see the chat at the moment, but if you are here and you are still with us, do let us know. And I hope Teams will not kick us out in the next few minutes. But even at that, let's continue until then. But in case it decides to terminate after 1 hour, please, you can always re-sign in. If not, we can continue. Okay, so talking about ISAs, within the ISA, at least in the UK, you can put in £20,000 post-tax, which will not be taxed after you to take out the money. And so with ISAs, you can allow your investment to grow tax-free within the ISA. And within the ISA, you still need to choose the type of investment you want within your ISA, but you have up to £20,000 that you can put in tax-free on a yearly basis. Now, if you are investing, you need to make sure you look at the charges. If you are being charged £1 in for the on a annual basis for the investment, then that can erode your return down the line. But if you try to keep down the charges, most times if you look at the prospectus of the fund, they will tell you the charges that is being charged on the annual basis. So keep it as low as 0.3% or even 0.4%, depending on your taste, but keep it very low, and by so doing you have more money in your investment account at the end of the 20 years, 35 years or so. Now, I'm bringing this gradually to a close, but before that, I want to show you an example. Now, I've used a stock and shares ISA calculator by Fidelity. Now, this is available online, and on this chart, you can see that if you decide to save £100 on a monthly basis, and you do not have a single payment, so when you are starting with £100, and you are assuming a growth rate of 7%, then in 15 years, your cash that you put in will be around 18,000, but at a growth rate of 7% in 15 years, it becomes 28,500 or almost 28,600. But if you look at the chart on the right hand side of the screen, in the first year, it appears that there is nothing. You only have 38, maybe around £38 in first year, assuming 7% growth rate. Second year, it appears that there is nothing happening. Third year, it appears there is nothing happening. But if you look down to about 15 years, you can see the difference. The green part is the return on the investment. So if you are putting money into an investment, you need to put it there for the long term, because in the first 5 years, you won't see a massive difference. So for example, if you only put this money there for 5 years, maybe you will get £1,000 or £964 as the return on the investment. But if you leave it there for 15 years, you get almost £10,000 more. So investment is for the long run. So even if you are putting in £100 on a monthly basis and you leave it in the investment for 15 years, then it can compound, and by compounding at a lower cost, you can have more at the end of the year. So you might open a shares ISA 1 year ago, or stock and shares ISA 1 year ago, and you say, it's not growing, it's very slow. Yes, it's slow for a start, but as you can see in this chart, it will pick up with time. So time in the market is more important than you trying to time the market. So your passive investment on a monthly basis might look very slow for a start, but give it time to grow. In 15 years, even in 25 years, you will see the massive difference. And this is why I want to encourage, if you're not paying into your pension or fully into your pension, pay into it, because you don't need the money now. Let it grow for 35 years, 30 years of you working. And by the time you look at it again, you will see significant growth there. Okay. So again, someone can tell you, oh, if you invest in this, you will get more compared to other stock market, as I've shown you. But if it's too good to be true, then it's most likely not true. So you need to be very mindful of this as well. Okay. Then on a personal level, for my investment, I use Vanguard. Vanguard is a low-cost platform. So I want to encourage you to go to Vanguard maybe at the end of this meeting and to check, look through what they offer, look at the various funds that they offer, and try to read through to see the prospectus, look at the charges, and from there you can begin to make selection. However, on a personal level, I invest in what they call the global all cap equity, that is investing in the entire stock market all around the world. Now, the implication of this is if you are someone that do not want to invest in tobacco company, for example, because of your faith, then you will struggle, because if you are buying the entire stock market, you cannot say, I don't want a gun manufacturer or a tobacco manufacturer or in your portfolio. So you buy everything. But if you want to take out some of this industry, then you can consider the ESG fund. It's called the Environmental, Social, and Governance Fund. So they are funds that are called, it's a new way of investing that is called ethical investing. So this type of investing, they try to take out maybe fossil fuel company, they take out gun manufacturer, tobacco, and just invest in what is left. So read through these different funds and then make a choice, informed decision. Now, I wanted to open the funds and just discuss it with you, but time is not on our side, because again, it's just so much that you cannot finish in a 1 hour session. So, but go through it. If you have any question or you are not clear, then you can, there is always opportunity for you to ask us more questions, and then we'll try to provide a video to just explain the concept for you on YouTube. And I might also look at this Vanguard fund, discuss it in a separate video in the future. Okay, so we have a few questions that are coming in. I'll just accept them, and then I will go to look at them. But if you are just starting in investment, I have 2 books to recommend to you. Very interesting book. The first one is The Simple Path to Wealth. Simple Path to Wealth is fantastic, not very long. J.L. Collins is the author, and it just provides some perspective about index investing and not, active investing. And with that, give it 7% return. Then over the long time, your capital will grow in the stock market or in the equities market. So the other book is I Will Teach You to Be Rich. So if you have access to Audible, to any book platform, try to read these 2 books. They are very helpful. I've read them, and they are very nice, helpful books. So those are some book recommendations from this webinar. Okay, so the next point is, what are the things you need to do from today? So first, you need to be intentional about your saving. You can decide to join our £500 before Christmas campaign. To join us, you can send an email to hello@equickstewards.com. Then you can also pay the maximum into your pension. Very important. It grows tax-free for the next 25 years, 30 years, 40 years. And you can see from the chart that I showed you, time in the market always win at the long run. Not for short time, but a very long time. So have a long time horizon, 15 years, 20 years, and then you can begin to build that wealth that you did not have, that no one passed on to you, even for your own children and children's children. Then consider passive investing in index fund, the global equity, to minimize your admin, so you don't have to think about it on a monthly basis, on a yearly, on a weekly basis, on a daily basis. You don't have to do that. Just set and forget. Every month when you are paid, say £100 go into this account, forget it there, and then in the next 1 year, review your investment and see how they are doing. Then this helps you to also keep the cost down. If you keep the cost down, then you can get more of your returns in your account. Like I said, 1% charges can eat away up to 28% of your returns if you are not careful. Okay? And if you have any question, you can also talk to a financial advisor. Like I said, what we are saying here, and my experience in going through the investment journey, you can also seek professional advice, and of course you have to pay for that. Okay, so for most people, if you read the books that I've suggested, you listen to our webinars, and you listen to other podcasts that are available, you don't need a financial advisor for now. Maybe when you start getting £100,000, £200,000, then you can start thinking of paying a financial advisor. But if you keep it simple, if you automate the process, then you can grow wealth without even having to bother about the admin that comes with it. Then, if you have any question, please join our Equip Steward community on Facebook. The URL is shown on the screen. There, you can ask questions, even anonymously, and we can respond to you. Or alternatively, if you don't want to ask anonymously, you can send your question to hello@equipstewards.com, and myself and the team of volunteers will try to answer your question as best as we can. Okay. All right. So before we take question, I just want to tell you about the next webinar. The next webinar will focus on harnessing real estate for generational wealth. So if you are in the UK and you want to learn how to save your deposit, how to step-by-step guides for you to be a first-time buyer, and the cost of home ownership is not cheap. Then also, if you want to go into real estate investment, what are the options? That will be on the 9th of September 2023. So join us for that webinar. The registration will open on the 26th of August. So you can go to Eventbrite now, just click on Remind Me, and it will remind you on 26th of August to register for the webinar. And I look forward to seeing you there as a continuation of this session.